Good morning, ladies and gentlemen. This is Clueless 8 Trading, and it's a Wednesday morning, May 18th, 2016. Wanted to go over some relevant charts and most importantly, find some sort of directional bias to these extreme, intensely volatile markets that we're undergoing. We have had several winners in the form of selective stocks that you all know. But when it comes to the overall indices, it is basically an intraday game of buying calls and puts. Swings are extremely difficult because the markets overnight tend to do very strange things. When we thought the market was going to completely crash on a Monday morning because of the weak Chinese data, they turned around and went up 220 points that particular day. And we had a tremendous day because we were overall biased long going into that particular Monday for reasons that I've explained on my previous video cast. Now, let's take a look at pure technicals and not waste time on these 20 minutes that we have on this particular video cast. So looking at the chart of the E-minis here, the S&P 500 E-minis, live action, we're down about 5.5 points, 5.25, and you can see the pattern symmetry developing here. The pattern developing here. This is a large consolidation channel that the S&P is following right now on a daily basis. It does not mean this is going to fulfill itself or complete itself down here at the low end of the channel around 2015. Which translates into 2020 or so on the S&P 500, on the SPX, which is pretty much a line in the sand for a good number of large technical analysts, institutional traders, and such. Saying all that, we have a couple of other things that are transposed on here, which we have to keep in mind, which have served us very well. For example, this magenta line here is the Darvas box. You can use that on your screens too. So when you look at that, when you hit the lower end of the Darvas back on the 6th of May, we had a very powerful bounce from this particular E-minis level of 2029. That's roughly about 2035 or so on the S&P 500, which I was also projected based on my work. And we had a very powerful bounce to the upper end of the channel. I did warn every single member free trial subscriber on Monday, take your large profits. Kept on saying that. If you scroll through my real-time Twitter feed, you're going to see that at this point, when there's a little bit of a mini euphoria, markets are ramping, all that good stuff. It was back here on over the weekend actually. Let me see, 13th. I mentioned that it's time to take profits. I did the same thing back on the 10th. When we hit the upper end of the channel. These are powerful resistance lines. Okay, this is a downtrend channel, and again the lower end of that consolidation channel, whatever you call it. So the lower end of the Darvas, you can track this, and remember, this is a dynamic market. Look, I'd love to put 90% of my investable, tradable capital, go short, and just sit there and make $1 million in 2 days. Okay, it just doesn't work like that. We all know that. When we lump in too hard on the short side, the market turns around and technicals get oversold, resets and everything. Algos come in, and there's a huge liquidity pump, and then you get these big candles. Okay, and that's what happened. A lot of this huge big candle that you're looking at burned billions of dollars worth of shorts on Monday. Okay. Even though there was that weak Chinese data, there were some positive aspects of the Japanese numbers and oil, of course, supporting the market. Then we had yesterday, which was this candle here. And you can see here that this could be, this is not necessarily inside day, but it was pretty much equal, it's, or to Monday. Now we're seeing this pre-market. So as you can see here, I'm going to be tracking this like a hawk. I am not going to be doing any big, massive trades. I'll be scalping, intraday scalps. We have some greens on the screen. We have individual news flows and individual companies like Tesla, VRX, things like that. Stocks that I post. A swing trade, NTLA, that's working out really good from about $21. Apple is still green. Looks like it still wants to go back to that 95 range. So selective issues are what we're talking about here. Overall market, let me get back to it. lower end of the channel is 2020 S&P, roughly 2014 on the E-minis. That's what it looks like it's going to land up doing. Now, keep in mind, this is monthly options expiration. So when people lump in one side or another, the markets tend to basically kill them. And all of a sudden, for nowhere, because this is what it is machine day trading. That's what's going on, all right, in the markets when it comes to the indices. And all of a sudden, they'll come in and just blow it up there. Saying all that, let's take a look at the internals. Now, one of the things that I showed yesterday and the day before is the fact that we had a positive divergence going into yesterday. Now we're coming down and we're starting to get quite oversold. Once you get to these levels here at around 8 or so, it's pretty deep oversold territory. I mean, you can go to you can go all the way down to 0, which can certainly happen, and that's what happened at the bottom of the market down here on when down in the 1800 level, as you can see, and these are pretty deep oversold condition. This was a positive divergence that played out very, very nicely in a big way. Now, forgetting the divergences, what we're seeing here with futures down 6, we're getting there. Okay, we're getting there. Now, this is a daily chart. When you get this oversold in the daily charts, you inevitably have a high probability V-shaped bounce on the STOs, which means you get these type of moves here. And those type of moves generally are basically 100 to 300 points to the upper end of the channel. Now, whether or not this gets oversold, whether or not this gets fully oversold, there's no exact time frame I can tell you. I can't tell you that it's going to deeply oversold in the first hour or today. Remember, we have the Fed meeting at 2 p.m. I'm not sorry, Fed meeting minutes released. That's the internal memos and discussions from the previous Fed meeting. So whatever the case, once we get down there, it's tough to be heavy short. Hedges are fine. Okay, I always just so that everyone knows, I always have a few hedges. Okay, I'm not heavy long right now. I have a couple of select positions that I put out there because you know what? You got to protect your capital. That doesn't mean you got to hide in a cave. It simply means you got to protect your capital. You got to have cash on the side so you can react to situations that's happening on the ground out there. So that's the picture. You know, the Darvas box here is at 2030. That's roughly about 2035 on the S&P 500, and then a slippage would bring us down to the lower end of the consolidation channel, which also coincides with the 200-day moving average, which is right here, this white line, and this curvy line, which is the Bollinger Band. Okay, so a lot of stuff going on here, and at some point or another, the market is going to basically, you know. Again, if you look at this as a head and shoulder, which it certainly is, you got a head here, you got a left shoulder, you got a right shoulder, okay? And this is the neckline. Once you break the neckline, that's where you get at. And if you do break that, then you're looking at 1980, which comes to about 1985 at 1986 on the S&P 500, okay? I can't project that far, meaning like, what's going to happen in this zone. There are guys smarter than me or dumber than me or whatever the case may be. I'm looking at things the way it's developing, okay? Because there are some very powerful cross currents that are developing, both on the negative side, which we're fully aware of, and some positive stuff that's developing also on the global liquidity side, which we are not aware of. All right. So that's the picture with your E-minis. Now let me get out of this here. Now, on the same time frame, if we look at what's happening on a shorter term basis, okay? So on a shorter term basis, this is the channel that the market's following. At the bottom end of the scale is 2022 again. If you look at this trading range here, downward sloping, channel trading, then you are looking at, so this is what the market's doing, right? You got some strong support here at this level. Is it possible that the market does that? These are the scenarios, okay? The bullish scenario would be that we basically move like this, hit this level here, and then make a sharp bounce, hit the upper end of the channel. Let's assume it fails there, back down again. If it doesn't hold, then we're going to come down here. That would be the bullish channel pattern, right? A dragon bullish within the formation of a large downtrending channel. If we break this here, the bearish play would be, and I'm certainly going to increase my hedges a bit as we get into the day because of things I'm explaining to you. All right, so you're protected and you make money that way. Puts that we bought at around 5 on Friday, They went to 7, then they, then they went to 8 and 9. I sold them roughly about 35-40% higher, and then they completely exploded. These were the 2060s, which I recommended. Some of you might have held it, and you know what? That's fantastic, because your job is not to mimic me. Your job is to basically take my ideas, suggestions, and basically work with it based on your own assumptions. Because remember, at certain times and probably a lot of times, you might be right. So give yourself credit. Don't always think that somebody knows all. I'm protecting my position based on the profits that I have. If I have a large position on the put side, and the market pulls back and I'm up nicely on the dollar side, I'm not going to look at a gift horse in the mouth, because I know that can be whisked away in 2 minutes or 2 seconds as the market reverses. So I'll do what I need to do, but my ideas are out there for people to act on. So the 2060s basically went to, believe it or not, they went to almost $17. Did I feel like crap because I sold out for 40% higher? Yes, because that would be a 200+% type of return, which we have done quite a few times. So things happen. All right. So bottom line is that the bearish scenario would be that we open and we immediately start to crash, which would be, that's why putting out a hedge first thing as we get into the market in about an hour, less than an hour, would be a wise, I think a wise bet. All right, because then this comes into play. Now, once you get here, do expect a reflex bounce. There's no question about it. And this is on a 1-hour charts. All right, so that's it. Now, let's take a look at what's happening on the internals, which I look at it very simply on looking at the fast stochastics. So looking at the fast stochastics here, remove drawing, we are looking at, again, we are not totally oversold yet, because totally oversold means that we have to get down here somewhere around the 0 level, or right there. You can see that, the white line, and that's roughly a -1. We're getting there. So is it possible that we get there right at the market open, as we see a slew of selling and stops triggered and stuff like that? Absolutely. Now, once it gets there, every single time the market has a reflex bounce, because you can't go below 0, right? So look at this. Look what happened. Now, this is obviously happening overnight. This is the E-minis. Look at Friday. Look what happened Monday. So every single time, without getting too detailed, you get down towards these levels, you get a tradable bounce. Now, the tradable bounce doesn't always have to be a V shape. Okay, it can basically meander around a little bit, and confuse people, and then take off. Whichever the case, you do get the inevitable bounce, whether it happens intraday or over a 24-hour period. That is left to monitoring the markets. So we're getting there. We're not there yet. We're getting there. And this can happen in literally 30 seconds as futures drop down, let's say 10 points before the open. We could very well be down here. So keep this in mind. For traders, it's very important to manage their intraday trades. Let's take a look at something else, which is real important. All right, and I'm going to bring this in into the picture. Bear with me. Okay, so that's good. All right, everyone can see this. Okay, 1 second. I think we need to move this a little bit towards this side. Perfect. And all right, so let's take a look at what's going on here, okay? Because this is important. This is your NYMO. This is your New York Stock Exchange McClellan Oscillator. The NAMO is a NASDAQ McClellan Oscillator. But let's look at this for a minute here. What I do is I transpose the pivots. So this is support S2, S1. You can see here that we bounced off S1, and regardless of yesterday's, this was the bounce of S1 on Monday. And regardless of the pullback yesterday, we created a higher high. That reflected itself in, 1 second, let me change the color. Perfect. Okay. So here you had these from last week. This was Friday's low. Then we had a big move up on Monday. So obviously the histograms, I'm sorry, the the NIMO bounced here and went from a negative 46, which is generally a short-term buying opportunity or a tradable low, as we like to call it. You can notice that every single time it gets towards these levels, you get a bounce in the market. It gets towards 90, you buy hands down. This is when we were in that 1800 level, and I'll tell you, these are massive buying opportunities. Okay, so bottom line is that without getting again confusing people, what you got to there's a couple of divergences being played out here, and I'm noticing it because that's what I do. So the NIMO, when it moves higher, as you can see, that's when you get those big rallies. And once it gets up again towards this is the pivot. The pivot is basically 0. S1, for example, 31 here. S1 is 40. Once it gets up there towards the upper end of the Bollinger, this red line is the Bollinger Band. You can see all the keys here, so you can read that what they are, right? Once it gets up there, that means the market's overbought. So the market's far from overbought right now, and we're seeing a slippage. So this being updated last night, it's possible that by the morning it is going to be down here in that, again, back towards the minus 46 range. Is it possible that that creates a triple bottom on the McClellan oscillator? Yes, it's possible. Now this is the other thing that I'm noticing from a positive divergence standpoint. The NIMO got down to these 40 levels, as you can see, negative 40 levels, okay, bunch of times. Yet, if you look at this particular picture of the MACD, the MACDs are actually almost positive. Now, what gives? That's known as a positive divergence. There's something going on underneath the market where prices are fluctuating, but then at the same time, certain sectors are doing better than others. For example, energy is doing strong. Biotechs, we have done well in them. Those are doing well, but energy is basically carrying the day. And on that front, if you look at the overall market, on the New York Stock Exchange, which is a lot of energy companies, you're starting to see some sort of stability or positive divergence. Because this, if you want to look at it this way, is a double bottom pattern. And if it goes higher, you create a small peak like that into the positive territory, and the NIMO basically moves higher. In other words, the Dow could very easily have a 100, 200 point rally, give or take, believe it or not, between now and Friday. Just showing you the possibilities, right? In the same vein, the same thing is happening. I put the full stows in here, the full stochastics, and you can see the full stochastics are also showing a powerful double bottom, similar to what happened back in December and January. Very, very strong similarities, which is at least for the bulls can project that there might be something of a powerful move higher. Now, I have no idea, because how these things develop and move forward, I can only tell by monitoring the charts during the day. So that's really the bottom line. If you look at the RSI, it's at 44. RSI down here at the 30 range is always a screaming buying opportunity. But we are kind of meandering up here in this level. So people can say two ways. One, the RSI can come down. It sure can, towards 30. And the bulls will say, hey, despite all this thumping in the market and the hits in the market, the RSI is still holding around 44. So there are two ways. Like I say, life is about looking at a glass half full or looking at a glass half empty. It's all about cognitive perception, about how you look at things. Whichever the case, it is an extremely volatile market. I warn everyone that you need to have hedges in what we're doing. And the reality of the situation is that you cannot rely on just prices alone. I'll show you another picture here. Okay. So here we have another shot of a chart that I've shown quite a few times. And that's what happened here. Which is, sorry about this. Okay, that's better. So let me move this out. Okay, that's good. All right. So if you look at this defined chart, and this is being run on the freestockcharts.com, the Warden platform, you can see here a very defined algorithmic high frequency trading range, right? So right now where we are, I believe, is we're down here based on what the futures are doing, right? S&P futures are down about 6. We closed at about 2047, so we're down here. So we are back to that trading range. I only have 50 seconds here. Study this chart. If we break here, then obviously the shorts are confirmed down towards 2020. Good luck to everyone. Thanks for your support. God bless you.